The U.S. economy unexpectedly contracted in the first quarter. As we look at the makeup of the report and then what the price action did with it, questions emerge about just how worried we should be. And of course, the markets managed to reflect exactly what the confusion seems to be, or maybe something else. We're going to try to unpick what's going on here. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And what we're going to try to make sense of here is what exactly the data told us, not only out of the U.S., but an avalanche of data, in fact, overnight from the world's major economies, and then see if we can't unpick what's going on here, not only with the situation in the global economy, but also in the market reaction to what seems to be going on here, because it does seem to suggest that perhaps at least some of the market is not prepared to say that the worst is here, or maybe a different explanation presents itself. And so let's go through here and see if we can't make sense of what today's price action appeared to offer. We begin first and foremost with a look at some data coming through out of China. We can see here the PMI numbers marking a downturn for April. We, of course, had numbers for the other major global economies published last week, and this kind of rounds out the story. And what we find here is that the world's second largest economy is basically at standstill. Now, this shouldn't really surprise anyone. The GDP numbers for the first quarter that came out continued to show the economy in its eighth consecutive quarter of what is essentially economy-wide deflation. The situation has not improved on that score, and so perhaps no surprise here. But nevertheless, the situation pointing to weak conditions and in fact, those conditions weakening. The manufacturing sector in particular slipping deeper into contraction territory. As always, of course, PMI numbers are looked at around a center line of 50, where above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And we can see here that the manufacturing sector here contracting and at a brisk pace, while the service sector slowed. And so the upshot for the composite PMI was standstill. We've returned to standstill once again. We've hovered near standstill for a while now, and we're essentially at the lower end of this kind of anemic range that has characterized China's economy, basically going all the way back to where the bounce from reopening after COVID restrictions fizzled in the first quarter of 2023. Then we get Eurozone GDP data, and it is a little bit better than expected, 0.4% versus 0.2% expected. And that is perhaps to some extent encouraging, but it also just lands us near the top of the range that we've occupied really since the beginning of last year. And so the upshot seems to be that the Eurozone's economy is no worse, but no better than it's been. So at least whatever issues may be coming up here, they are not getting necessarily worse in Europe, and perhaps at least there we have something of a bright spot in the overnight news flow, but that really is about it. Because later, in just a few hours' time after this, we get the U.S. GDP report. And here we get the first contraction in GDP in 3 years, down 0.3%, versus a rise of actually the same magnitude, 0.3% expected. And what we find here is, of course, that the internals are significantly skewed by the tariff drama that we've been watching. And we see an absolutely off-the-charts surge in imports that then makes net exports minus imports, appear like a tremendous drag on the overall picture. So we end up with a surge in imports of 41.3%, whereas exports only rose 1.8%. So there is, needless to say, a very sort of idiosyncratic factor here. But if we strip that away, it remains that consumption, which is by far the largest component of GDP, to put this in context, consumption was 68.5% of the total, whereas exports minus imports amounted to about 5%. Exports were about 11%, imports about 15%. And of course, the GDP calculation is net of those two. So exports minus imports altogether, we arrive at about a 4 to 5% share of overall GDP. To consumption's 68.5%. So clearly, that's the much larger influence. And for consumption, we find that we're growing at an annualized rate of just 1.8%. That is the lowest since the second quarter of 2023. And so, needless to say, the markets do not like this. And what this points to is a weakening of demand in what has been the standout for global growth. And this really is where this gets ominous. The global economy is 58% US, the Eurozone, and China in terms of their share of GDP. The remaining 42% are for the most part vendors to the former three. So think Canada and Mexico with the US, or Central and Eastern Europe with the Eurozone, or Australia and New Zealand and many of the world's commodity exporters with China. But with all of that in mind, the data we've just seen over the course of the past 24 hours tell us China remains anemic. The Eurozone is maybe not as bad as feared, but also not much better than it's been. But the U.S. seems to have dramatically slowed. And that, of course, echoes what we've been seeing in the PMI numbers. Since the beginning of this year, this right here is December of 2024, where U.S. economic activity peaks. From here onward, what we find is a dramatic deceleration in the U.S. since the beginning of this year. And the story of last year, where, of course, already from mid-year, China was slowing and Europe was slowing, but the U.S. was clearly holding strong and posting some of the strongest growth levels since early 2022. Here now, the situation has turned. And it's not like China and Europe are catching up to the U.S. No, it's the U.S. catching up downward to what's going on in these economies. And so we can see here very clearly that what seems to be occurring is the whole of the core of what powers the global economy is trending toward standstill. Now, in particular, when the U.S. GDP numbers hit the wires, stocks swooned. You can see here the S&P 500 spiked sharply lower here. At one point, it was a loss of as much as 2.2%. But by the end of the day, that gets unwound. In fact, less than 2 hours after we hit the lows, we're already starting to claw back higher. And we actually manage a mildly green close here, a mildly positive close for the day. So is it that the markets are afraid of recession, or isn't it? And does this rebound then suggest that perhaps we have a sort of price mechanism that's signaling to us that the markets are actually not that afraid, that the numbers were uncertain, but that ultimately risk sentiment held up and we've shrugged this off? And it's clearer skies from here. Well, not so fast. Because if we look at what has happened with other cyclical and growth-sensitive names and assets, we don't have much of a positive story there. Crude oil is sharply lower today, approaching its recent lows. Obviously, this is energy, and so it makes sense that this would be as hampered as it is if what we're concerned about is global growth. That global growth consumes energy, and you might expect that energy demand would weaken in a downturn scenario. Copper, another bellwether industrial commodity that is even sometimes referred to as Dr. Copper for its sort of early detection of economic weakness. It is shellacked today. Sharp move lower for copper that comes a hair off the lows into the close, but clearly sustains a dramatic decline here as relative to the rebound in stocks. Finally, the bond market shows us that what we find here is a further pricing in of lower rates in the near term. This is the 2-year note, ZT here. This is the most sensitive to near-term Fed policy expectations. What we see here, of course, is as the bond price goes up, which is what we see here today, the commensurate yield is going down. And that is telling us that we are now baking in the most dovish outlook for policy, at least as far as this is implying, since we were here back at the beginning of April and the markets were freaking out about quote-unquote Liberation Day. And indeed, if we look at what is apparently going on here in Fed policy expectations, what we find is that the markets are now looking at Fed funds futures, baking in 96 basis points in rate cuts this year. That is, of course, a staggeringly dovish view, considering the Fed anticipated half that, about 50 basis points, and the markets themselves anticipated as little as one rate cut at the start of this year. Going back to, let's call it, even as recently as February, the markets only had priced in 25 basis points. And of course, over the course of this stock market sell-off, that has built out. But moreover, next year has priced in 32 basis points. And so we've arrived at essentially a 5 rate cut tally, greater by 1 rate cut than the Fed has anticipated. Moreover, looking at the likelihood for what happens next, May, of course, still very much pointing to no change in the rate structure coming at the next policy meeting. But by June, the probability of a rate cut has jumped to 64%, which, if we compare this, let's say, from some of the recent numbers, is something of a dovish adjustment. In fact, just a week ago, it was more like 55%. And so it was basically a coin toss. The market's clearly reading this data today as suggesting the Fed is likely to be more dovish. And why would the Fed be more dovish? Well, because there's an economic downturn that's in the works. And so with that in mind, this kind of resilience in stocks starts to look suspect. And one starts to wonder how it is that other markets, bonds, commodities, they seem to be screaming that there is something of an issue here, and stocks are holding up as well as they are. And some of that perhaps reflects the expectation that the Fed is going to cut and that these cuts might be coming sooner, and perhaps that is to some extent encouraging. And perhaps that is what's at work, but then you might expect that you could have a better result on crude, a better result on copper, because if rate cuts are going to backstop the economy and the markets believe that, then some of these growthy commodities might look better because the threat to their demand might not be as acute. Another explanation seems to resonate a little bit better, though, and that is the deep stock of event risk on the corporate earnings side this week. After the close, we, of course, had earnings from Microsoft and Meta. They beat expectations, but the markets didn't know that at the time that they recovered their intraday losses. They just knew that there was big event risk that was incoming. Moreover, we have Apple on the menu for tomorrow. So some of these huge names where all of this market cap is built up, the deep, deep concentration names, they're reporting earnings this week. And so it does seem to make sense that if investors are reluctant to jump in front of event risk, that stocks would be doing what they're doing, but everything else would be doing what it's doing. And so stocks here look vulnerable because this resilience seems more tactical than it is substantive. And with that, we turn to U.S. ISM manufacturing data. That's coming out ahead of Friday's NFP report, which we'll tackle on tomorrow's episode in excruciating detail. But here, what we're looking for is for the service sector to contract, and those numbers will be with us next week. The manufacturing component is seen contracting for a second consecutive month, and the pace seen accelerating to the fastest in 7 months. That is the pace of contraction. And again, this is around 50. So this 48 would be a contraction, and that this would be a lower number, sub 50, than the prior month would tell you that contraction has sped up. Now, Citigroup data here is suggesting that U.S. economic numbers are tending to surprise on the downside relative to expectations. That's this negative number on the Citigroup Economic Surprise Index. And with that, we have the risk that the number might even be weaker than expected. And as the evidence continues to mount and the earnings reports that we're looking at continue to get out of the way, the resilience in stock markets seems likely to give way. Now, we may have to wait until Friday's NFP report to get to the full reading on this, But if these ISM numbers are going to end up soggy, the resilience in stock markets may already start to show some cracks. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. I'm back with Chris for Futures Power Hour Fridays and Mondays. In just 30 minutes time with Victor Jones for the Price of Truth. Back with Victor on Sundays alongside Tom for First Call. Writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.